Laurel Starks here, the CEO and founder of the Alumni Institute. And today I have brought in one of our resident faculty members, Jason Gordon. Jason is a mortgage lender. He has been a mortgage lender in the lending industry for well over 20 years. He's got his MBA. He serves on the faculty. So Jason is going to talk with us. Anytime there's anything going on in the lending world that impacts that rates and all of that sort of thing, I want to hear from Jason. And I just always have questions. So I pick up the phone and I give him a call. I say, Jason, I see what's going on in the headlines. Now, can you explain it to me as my own personal expert? So that is what we are here today to talk about. And instead of me picking up the phone, I thought, hey, why don't we, whenever I hear Jason? So we have heard in the news that the rates have increased. And as you all know, many of you who listen to me talk about market conditions, et cetera, one of the biggest metrics in the real estate industry as it relates to prices and home sales, et cetera, one of the biggest metrics to look for is interest rates. So that's been all over the headlines. Jason, why don't you explain to us what is going on with interest rates, what's just happened, and how is that impacting borrowers?
Well, hi, Laurel. Hi, folks. Thanks for having me. I appreciate it. Always nice to be on. Well, we obviously have seen a lot of changes in mortgage rates leading up to, through, and then post-pandemic, assuming that we can call it post-pandemic at this point in time.
Let's assume we can.
Yeah, I hope so by now.
Yeah.
A general rule of thumb to know, and this is in any market, when there's bad news for the economy, it's good news for mortgage rates and vice versa. So when you think about what happened early in the pandemic, it was a lot of bad news. There were upwards of 40 million unemployment filings in about a 6-week period at one point in time. And that really is historical bad news. You look at any chart where it shows unemployment, that was a spike like nothing we've ever seen in history. And most of us benefited from very low interest rates. I think we all refinanced once or twice over the last couple of years. Wonderful time. But when you come out of the pandemic, when people start going back to work, it creates not only a lot of good economic reports, but it's actually kind of artificial, because instead of starting kind of at ground level and taking a step up, we were down in the ditches to get to ground level before we took a step up. And that first from underground to ground level is a metric that that influenced a lot of rates. It looked like rates were getting, or that the economy was getting better than it really was. I'm not going to get political here, but someone might say that, hey, under my watch, look how many jobs I created. Well, did you create the jobs, or did people just go back to work in the jobs they already had before? But what's happened here is we see what looks like a lot of really good news for the economy. And that has fueled inflation. And inflation is the mortal enemy of mortgage rates. So as we look at how much it's costing to fill our tanks of gas, those of you who still are getting gas, I'm one of them, and I'm watching those prices get higher and higher per gallon. That's a sign of inflation, and we see mortgage rates doing the same thing.
Okay, because I was going to ask you, when you said that when the economy gets better, interest rates rise, but then we're looking at this major inflation. So it depends on, I guess, how you define how good the economy is getting. But I hear what you mean about unemployment and spending and that sort of thing. So then when inflation increases, then that drives mortgage rates higher?
Yes, well, behind inflation, though, because we look at inflation as this really bad thing, but what's behind inflation is more people are back to work. They have more discretionary income. So they're out there spending more, not just on what they need, but what they want. That's causing a lot of these merchants who benefit from those dollars spent to hire more of their staff. So and of course, at some point they say, wow, we can get more money for our goods and services. Let's do it. So while inflation kind of feels painful to the consumer, it's often considered a byproduct of an improving economy, which is bad news for mortgage rates.
Okay. So it's not just because oil prices are higher and that therefore causes an increase in goods and services. It's also because because more people are back to work and we've just got the economy functioning again.
As irritating as high gas prices are, that's a drop in the bucket of what's being looked at as an economy and sort of as a barometer as to the health of our economy. The backbone of these metrics is employment. People are back to work. I mean, imagine the average household. They have their needs, they have their wants. The needs, they have to be under a roof. They have to have water and food and electricity. Those get paid with the money they have. But the wants, I want to go on vacation. I want to travel. I want to hop on a plane. I want to go to a nice, resort. I want to get a new TV, a new car. In many cases, those are wants that tend to get sidelined when you only have a certain amount of money in the household, when your full-time job went to part-time, when you're furloughed for an indefinite amount of time, if you're just flat out unemployed. And so a lot of households, I mean, if you think about the pandemic, I mean, huge spikes of homes that the incomes were just disrupted like they never have been before. To come out of that, it just looks like a lot of improvement to the economy. And that's what's fueling a lot of the interest rates going up right now.
That makes a lot of sense. And I know from traveling and looking at reservations, I mean, good luck trying to get a good reservation at a decent resort anywhere within these next few months. My anniversary is coming up in May, and we tried to book, and I'm telling you, everything's full. I mean, it's kind of it is crazy. So yeah, that makes a lot of sense. Okay, so then with regards to the increase in interest rates, can you tell us what was the low, and then now where do we typically sit? How much have they gone up?
Are you talking about the lowest interest rate we saw during the pandemic versus now? Oh gosh, I'm Mr. Disclaimer on those. I like to tell you a million disclaimers as to depends on the credit score and the equity and the loan amount, all these jumbo loan versus conforming FHA, VA. I would just say as a blanket statement, so that nobody comes over and says my rate was lower, that rates had gotten to the low twos on a lot of the 30-year fixed programs, whether VA, whether FHA, whether Fannie Mae, Freddie Mac, even the jumbo non-conforming. Right now, we're seeing those up about 200 basis points higher in many cases. So into the fours, and in some of these, even into the fives, dare I say.
Wow.
Just in the last 3 months, mortgage-backed securities have worsened about 500 basis points, which is very, very significant in a short term. A lot of this has to do with the before mentioned variables. I won't say those over again, but it's been a systematic increase of rates since the low point in the pandemic. I'm seeing a lot of rates right now comfortably into the fours, even again, sometimes even a bit higher given certain situations.
So what does that translate to in terms of qualification and a house payment for a borrower? Let's say, a borrower maybe doesn't have a rate lock. Maybe they were pre-approved for a certain amount of money. Maybe they either haven't found the house that they want, or they have, but they didn't lock their rate. So what does that look like in terms of an increase? Because the next place that goes is affordability. When you've got obviously increase in prices, all-time highest prices in the United States for homes. And then we've got interest rates that have, by what you're saying, they've almost doubled in some instances. So not quite, but they've gone up significantly. So what does that do to a mortgage payment?
Yeah, I would definitely say a bit less than double, but definitely a significant spike. And kudos to you for bringing that up, because many people think, oh, the rate quote I got on Monday is good on Tuesday. It's not. If you're either locked in or you're not, and I mean that nicely, if you're not locked in, you're what's called floating. That market could move up and move down, and lately it's moved up. And behind everything that we do is math. And so when you look at an average mortgage payment, we have what's called PITI, principal, interest, taxes, insurance. The last two, the taxes, insurance, they'll be what they're going to be based on the home you're buying and what the taxes are going to be and the sales price and the insurance that you're getting. But that PI, that principal and interest, is calculated with three different variables in mind. The first is the term. We'll call it the amortization term. In many cases, 30 years. Second is the loan amount. The third is the interest rate. So just by mathematics, as the rates go up, even if you keep the same term and the same loan amount, the payment, the P&I portion of the payment keeps going up. And then the bigger picture on that is when you're qualifying for a loan, one of the metrics that we use to make sure that you meet what's called ATR, ability to repay guidelines, is what's called a debt to income ratio, or DTI, which looks at the cash flow. Top of the fraction is the total debts you're going to try to get when the smoke clears. Bottom of the fraction is the income. And so if you're already maxing out the debt to income ratio before rates start spiking up high, that same loan amount at that higher rate can put you in a decline status or force the lender to counter you to get that lower rate, but pay a bunch of extra points and upfront costs to get that rate, or just force you to take a lower loan amount, which might mean a lower sales price, which might mean that you have been hunting in a certain purchase price target range and no longer can perform at that range.
Yeah, that's what I was thinking, because in working with home buyers, I mean, in order to get into the neighborhoods and to get the kind of home that they want, a lot of home buyers are already pushing that DTI, because what they were able to afford last year versus what they can qualify for today for that same exact house is very different. So just to be able to get into the neighborhoods and get into the school districts and get the amenities of the home that they really want to get into, it means that they're having to sometimes push those limits. So now what you're saying is, I mean, that's just to deal with the increase in values. But now what you're saying is increase in rate as well. So it's costing them more to borrow that money. And that's going to be a deal killer for a lot of people.
Well, yeah. And you nailed that, because going back to that principal and interest payment, remember I mentioned loan amount and I mentioned interest rate. We talked about the interest rate going up, which affects the P&I, the principal and interest. But if the loan amount goes up higher, if you're doing 80% of some amount of sales price, and that some amount of sales price goes up 50 grand, then the math means that the 80% of that higher sales price is a higher loan amount combined with the higher interest rate is a double whammy to the payment.
Do you have any sort of a guideline, like how much more does a house payment increase with every 1% of an interest rate or something, just to give some kind of a context to affordability and the interest rates, to correlate that? And I don't mean to put you on the spot. I know you love when I do that.
Yeah, no, I love when you do that too. I know there's charts out there that say, for every $1,000, it's, six, whatever. I've never looked at those that carefully, because I look too closely at the other factors. Yeah. Higher sales price equals higher property taxes, might equal more homeowners insurance you have to cover. That higher loan amount might put you in from a conforming size loan to a high balance conforming, or maybe even to a jumbo. Maybe because of the higher sales price, you only had a certain amount of money you can put down. Now you have to do a different program, like an FHA loan, to leverage, less of a down payment amount. So I guess I'm giving you a long answer.
I get it.
That's not what you're looking for, but yeah.
Well, that's all. It's almost like that figure. It pales in comparison to all these other things. It could be complete disqualifiers to begin with. So, I mean, I didn't even think about that property tax is tied to home value, and that increases. And as that increases, then your DTI is increasing as well. And so, I mean, there's just a lot of factors that happen in a moving market like that. So
100%. And if you're putting less down, now you have private mortgage insurance. Are you going to switch to a condo? Now we have HOA dues to look at. Are you going to buy new construction and have metal roofs or special assessments? So yeah, this is where I guess I'm too deep into the woods to give you a quick answer, because it all correlates to the evolution of a typical home buyer search. And with these rising rates and rising values, a lot of them are pivoting and changing their plan completely.
So, okay. So then what would you say to anyone? So we have real estate professionals who are watching this. We have got everyday consumers who are watching this. And then we've also got divorce professionals who are watching this. So what would you say for a regular buyer borrower with regards to the interest rates and somebody who, is wanting to buy a house, or maybe they're in the process of it? What would you say?
A couple things. Number one, let's be smarter consumers. Okay, there's two different ways that we all pay when we get a mortgage. There's the upfront cost. We call those non-recurring closing costs. And then there's the interest rate, which is the ongoing cost. Mm-hmm. If I asked you either one, you want low fees or high fees, you'd say low fees. You want low rate or high rate, you'd say low rate. But you don't get both at the bottom of the spectrum at the same time. Imagine a seesaw or a teeter-totter. One goes down, one goes up. We live in a soundbite generation. 30 seconds to get your attention to make you want to buy. Yeah. The advertisers are going to tout the one low part in their headline when they scream to get your attention, and they're going to whisper just loud enough to be compliant in the fine print, the high part. Let's stop thinking there's a magic bank. Oh my gosh, I had the perfect, radio commercial while I was driving home from work. I found the magic bank. You did not find the magic bank. So the combination of the two is called pricing. Pricing is either locked in or it's not. And so whether you are a home buyer or whether you're a homeowner, whether you're a real estate agent, financial planner, CPA, or divorce professional helping this population, again, Monday's quote is no good on Tuesday unless you locked in Monday. So we are susceptible to external variables, bigger picture changes that are going to move the environment. And over this longer period of time, especially if you mentioned divorce professionals, which I know you and I are very, very entrenched in. Mm-hmm. I do a lot of divorce equity buyouts. Imagine the in-spouse, one wanting to keep the home. They negotiate, an idea of a divorce equity buyout sometime in, second quarter of last year. But then they have to wait for the divorce to progress. They have to get their 6 months of receipt of their spousal support to qualify. They didn't stop the pendulum from swinging when they first talked to me back in the second quarter of last year to where we are now. With the rise of rates, with the rise of home values, the math changed on these. And so they may be seeking a higher, what they call equity buyout amount, because that departing spouse, that out spouse says, well, hey, wait a minute. House went up an extra 40 grand during that time. I want 20,000 more. And you factor in the higher rate. What was once a done deal, approval for that divorcing homeowner may no longer be an approval because the math has changed. And that's the same if whether it's a divorce or not, whether it's someone just buying a home. You're a real estate agent, your pre-approval from last year needs to get updated, needs to have the current numbers in there in place to make sure that this borrower still does qualify.
Yeah. So, there's a saying, the wheels of justice move very slowly, and yet rates are no good 24 hours later. Right. Like you said. So,
welcome to my world, my friend.
Yeah.
They're constantly changing. Yes.
So if you're a divorce professional and listening, and you've got cases where there are buyouts, whether your client's getting bought out or your client is doing the buyout, and that was negotiated maybe 6 months ago, and maybe they do or don't have a pre-approval yet, or they got a pre-approval even 3 months ago, it is going to behoove you to reach out to opposing counsel, opposing party, your own client, whoever it is that's obtaining the loan, and say, A, did you lock the rate? Are you in the midst of the refi? Did you lock the rate? And B, if not, then I need an updated pre-approval that is dated today. Is that what you would say?
Well, as our attorney colleagues would echo, the exhibits in the file become stale dated. Yeah. They must be updated.
So, a loan approval prior to 2 weeks ago is probably stale unless they've locked the rate.
I would say
yesterday. Technically,
well, it feels yesterday. Like they're changing a lot as of late. What typically happens, and I say typically because if they're just on the edge, hitting their head on the ceiling of approval guidelines here, then one change can actually get them from a approval status to a decline status. More often than not, we lenders could be pretty creative. I always use a football metaphor with my real estate agent partners. I said, you give me the ball inside the 5-yard line, I'll find a way to get it across the goal line. You get me that close to the goal line, there's math that can be done. We can renegotiate the homeowner's insurance, or, maybe change our deductibles, maybe pay a point on the rate to buy the rate down enough. But to the bigger picture that you're describing here, when you see these profound changes over the last 3 months, I mean, 500 basis points, mortgage-backed securities have changed. That's impacting the mortgage rates well over a point.
Mm-hmm.
And it's just math. And if it's, $100,000 loan, that's not as much of an impact on payment than it is $1 million loan. But it does at some point, the math can get to that, that borderline.
Well, and I think the issue is, and it's not, and just to clarify, it's not just the amount of the buyout, but it's meaning their portion of the equity. It's obviously wrapping in the existing mortgage to that. So if someone has a $500,000 existing mortgage and their house is now worth $1 million and there's a 50% buyout, then it's a mortgage of $750,000. So when you're talking about a point or more that rates have gone up, then on a $750,000 loan, that's pretty significant and can completely kick somebody out of the realm of qualifying, depending on how close they were. So then it would be definitely to update any pre-approvals. If you're a listing agent like I am, checking in on the buy sides, making sure that buyers have locked their rates. Do you have escrows that are still going to be able to close? And then obviously if you're an agent working with buyers, making sure that they're operating with the most current information and the most current data.
100%. And another thing too, sometimes we lenders can approve somebody at these high debt to income ratios, but the borrower says, wait a minute, that's outside my comfort zone.
That's good.
You're not factored in, the things I spend on meals and entertainment and other things, loan people. I my comfort level is $3,000 a month. Thank you for approving me to $3,800 a month, but that's a stretch for me.
Yeah.
So that's where we have to always, under all this, let's keep our clients in mind, keep them in communication with whatever lender they're working with, because that approval still might be there, but the desirability to pursue the loan may have changed when those numbers change.
May not be. Exactly. So with home prices that are consistently increasing daily, combined with interest rates that have just taken a huge jump, it's really something that buyers need to make sure, and their professionals need to make sure that they're right on the cusp of. Okay, great. Jason, is there anything else that I am forgetting to ask you?
No, I think that was very, very, very thorough line of questioning. So thank you.
All
There's
right.
plenty more I could talk about, but at some point people are going to turn off the podcast. Like, all right, enough mortgage guy.
Enough. I get it. Awesome. Well, thank you very much for always taking my call. And if anybody else has any specific questions, how do they get a hold of you?
Cell phones, just like many of you, I have that thing attached to myself at all times, 619-200-8031. And I do have one of these little fancy schmancy electronic business cards. Just go to VIPborrower.com, VIPborrower.com. You can add me to your phone. You can look at my Yelp reviews. I'm one of the few crazy lenders that actually has his own Yelp page. So check me out, vet me before you or your clients reach out to me if you'd like. VIPborrower.com is the best place to go to stalk Jason and get a hold of him at the same time. And one last thing before you go, just for my compliance people, because they always get really angry. My NMLS ID is 259027. This is not an offer to lend, merely educational purposes, and we are an equal housing opportunity lender.
Love it. Perfect. Well, thanks, Jason. You go and have a great rest of your day, and I appreciate you dropping some knowledge for me and for our friends.
Always a pleasure, Laurel. Take care.
Take care. Bye-bye.